Hello and welcome to another episode of Knowledge Nectar Insight. I'm your host, Jake, and today we'll be diving deep into a topic that might seem dull at first but has huge implications for your day-to-day life. You've read the title, Revealed: What Really Happens When the Federal Reserve Ups Rates. The Federal Reserve, often referred to as the Fed, is the central banking system of the United States. One of its main roles is to manage the monetary policy of the U.S., which includes the adjustment of interest rates. But what really happens when they decide to increase these rates? Let's break it down. Number 1, your borrowing costs increase. When the Fed raises rates, the first thing you're likely to notice is that the cost of borrowing money goes up. This includes everything from mortgages to credit card interest rates. The Fed raises rates to slow down inflation, and higher borrowing costs are one way to achieve this, as it discourages people from taking on too much debt. Number 2, the stock market reacts. Higher interest rates mean that borrowing costs for companies increase as well, making it harder for them to expand or hire new employees. This can lead to lower company profits, which might result in falling stock prices. However, the reaction of the stock market can be hard to predict, as it depends on a variety of factors including investor sentiment and expectations. Number 3, your savings may earn more. Here's the silver lining. When interest rates rise, the amount you earn from your savings in a bank or a similar financial institution could also increase. This is because banks and other institutions often raise their own rates in response to the Fed's changes, so they can attract more deposits. Number 4, the value of the dollar might increase. Higher interest rates in the U.S. can make dollar-denominated assets more attractive to foreign investors. This could result in an increased demand for the dollar, thereby strengthening its value in comparison to other currencies. And finally, number 5, government debt service costs rise. The U.S. government borrows money by issuing bonds. When rates rise, the cost to service that debt, meaning the interest that the government has to pay to its creditors, also increases. This has implications for public spending and the national debt. In short, a decision by the Fed to raise interest rates has far-reaching effects that impact not just the national economy but our personal finances as well. It can make borrowing more expensive, affect the stock market, potentially increase the return on your savings, influence the value of the dollar, and impact government spending. Understanding these effects can help you make more informed decisions about your own finances and investments. And it's fascinating, isn't it, how a decision made in the halls of the Federal Reserve can ripple out to touch us all. If you find these insights as intriguing as we do, then why not hit that subscribe button? Remember, at Knowledge Nectar Insight, we're always bringing you more fascinating content, making the complex clear and accessible. So stay tuned and join us in our next exploration. Until then, keep quenching your thirst for knowledge.